In March 2026, China's cross-border payment system processed 1.22 trillion yuan in a single day. That is roughly $178 billion, settled outside the dollar system, outside SWIFT, outside anything Washington controls. On the same day, U.S. national debt crossed 39 trillion, a number so large that the interest payments alone now exceed what America spends on its entire military. These two events are not separate stories. They are two ends of the same fuse. For 52 years, every nation on earth that wanted to buy oil had to buy dollars first. That single arrangement, not the Constitution, not the military, not Silicon Valley, is what made the United States the most powerful financial empire in modern history. And that arrangement is now unraveling, not in theory, not in a think tank paper, in the settlement rails, the reserve allocations, and the swap agreements being signed right now. What you are about to see is the mechanism underneath the collapse. The math most people will not understand until it is far too late. If you have been watching the financial news, you have heard two completely contradictory stories. Story 1, the dollar is still dominant. Story 2, the dollar is dying. Both are being reported on the same day, by the same networks, sometimes by the same person. The confusion is not accidental, it is structural. Think of it like an iceberg. The part above the waterline, the headlines, the daily currency charts, the stock market highs, shows a dollar that still commands 58% of global reserves. That looks stable, that looks dominant. But beneath the surface, the mass is shifting. Central banks bought over 863 tons of gold in 2025 alone, the fourth consecutive year of historically extreme accumulation. China has slashed its U.S. Treasury holdings from $1.3 trillion in 2013 to $682 billion by late 2025. Saudi Arabia signed a $7 billion currency swap agreement with China, allowing direct settlement in yuan, bypassing the dollar entirely. These are not opinions. These are not projections. These are completed transactions. The surface says stability. The structure says repositioning. The question is which layer you are watching. The trigger is not one event. It is a sequence. And the sequence began with a silence. In June 2024, Saudi Arabia did not renew its 50-year petrodollar agreement with the United States. No press conference, no emergency summit, no explanation, just the quiet expiration of the single most important financial arrangement of the modern era. For context, in 1974, Henry Kissinger and the Saudi royal family struck a deal. Saudi Arabia would price all of its oil exclusively in US dollars. In exchange, America provided military protection, weapons, and a guaranteed security umbrella. Every other OPEC nation followed Saudi Arabia's lead. Overnight, every country on earth that needed oil, which meant every industrialized economy, had to hold dollars. The dollar became the world's reserve currency not because of economic strength alone, but because of oil. That deal expired. And what followed was not chaos. It was architecture. In September 2025, Saudi Arabia formalized a strategic mutual defense agreement with Pakistan, a comprehensive pact that placed the kingdom under Pakistan's nuclear umbrella for the first time. The American security guarantee, the original reason the Saudis locked themselves to the dollar, was being replaced. Then came the infrastructure. Saudi Arabia's central bank joined the mBridge digital payment platform, which allows direct currency exchanges through blockchain. No SWIFT, no American intermediary banks. Think of it this way. Imagine a dam that has held back water for 50 years. No one blew it up, but someone quietly opened the valves. The water has not crashed through yet, but the pressure is now on the other side of the wall. The trigger is not an explosion, it is an opening. And what is flowing through that opening is trade settlement in currencies that are not the dollar. Here is where the mechanism becomes visible, because the question is not just what Saudi Arabia is doing. The question is what every other institution on earth is doing in response, and why the Federal Reserve cannot stop it. Start with the math. The U.S. government now pays more than $88 billion every month in interest on its national debt. That is $22 billion per week. In the first 6 months of fiscal year 2026, interest payments totaled $529 billion, roughly equal to spending on the Department of Defense and the Department of Education combined. The Congressional Budget Office projects interest payments will hit $1 trillion this year and $2.1 trillion by 2036. This is the trap. The Federal Reserve cannot raise rates aggressively without making the government's borrowing costs catastrophic. But it cannot cut rates aggressively without accelerating the dollar's decline against other currencies. Every square on the chessboard is covered. The king has no clean move. Now watch what the institutions are doing while the Fed is frozen. China's CIPS, its cross-border payment system, shattered records in March 2026. Average daily transactions climbed to nearly 36,000, up from 26,000 in February. Average daily value surged to 920 billion yuan, a 50% jump in a single month. Iran, locked out of SWIFT by American sanctions, now sells 90% of its oil exports to China, settled entirely in yuan through Project mBridge. The system handled over $55 billion in trade in March 2026 alone. The European Central Bank president declared publicly that the current moment presents a significant opportunity for a global euro moment, as investors reduce their exposure to dollar-denominated assets. And then there is gold. Central banks purchased over 1,000 tons annually for 3 consecutive years, 2022, 2023, and 2024. In 2025, the number came in at 863 tons, still nearly double the pre-2022 average. The buying is not speculative, it is sovereign policy. The institutions are not watching the petrodollar unravel. They are building the replacement while it does. The narrative says stability, the balance sheets say exit. The structural consequence is not a crash, it is a melt. An ice cube does not shatter. It loses mass slowly, invisibly, drip by drip, until the moment you look down and realize the glass is empty. That is what is happening to the dollar's structural demand. The petrodollar system created artificial demand for the dollar. Every barrel of oil sold anywhere in the world required dollars. That demand allowed the United States to borrow cheaply, run persistent deficits, and print currency without immediate consequences. The world absorbed American inflation. America exported dollars. Everyone else exported goods. The French called it the exorbitant privilege. It was not a compliment, it was a diagnosis. Now run the math forward. The dollar's share of global foreign exchange reserves has fallen from 72% in 2001 to approximately 57% today. That decline has been gradual, but gradual is the point. The petrodollar does not collapse in a headline. It erodes in settlement agreements, in swap lines, in vault allocations. Every percentage point of reserve share that the dollar loses reduces the structural demand for U.S. Treasury bonds. Less demand for treasuries means higher borrowing costs. Higher borrowing costs on $39 trillion of debt means the interest bill compounds faster. The interest bill already consumes 19 cents of every dollar the government collects in taxes. By 2036, it will consume 26 cents. This is the minimum payment trap. The balance never goes down. The interest keeps compounding. The hole gets deeper every month, and the shovel keeps getting smaller. The question is no longer whether the petrodollar system is weakening. The data has answered that. The only question is speed. The direction is what the math dictates. There is one historical parallel that makes the current setup unmistakable. August 15, 1971. On that day, President Nixon closed the gold window, ending the dollar's convertibility to gold. The Bretton Woods system, which had anchored the global monetary order since 1944, died in a single televised address. Within 3 years, inflation in the United States doubled. The dollar lost a third of its value against major currencies. Gold rose from $35 an ounce to over $180 by 1974. But here is what matters. The structural conditions in 1971 were mild compared to what exists today. In 1971, the debt was manageable. The dollar's share of reserves was unchallenged. There were no alternative settlement systems, no digital payment rails, no CIPS, no mBridge, no yuan swap agreements. Today, every single variable is more extreme. The debt is 98 times larger. The interest burden is 71 times heavier. The reserve share is 28 percentage points lower. And for the first time in history, functioning alternatives to SWIFT and dollar settlement exist, and are processing real volume at scale. After Nixon closed the gold window, it took the Petrodollar deal, 3 years later, to rescue the dollar from free fall. The Kissinger-Saudi arrangement gave the dollar a new anchor. That anchor is what is now being removed. And this time, there is no replacement anchor waiting. There is no second Kissinger deal in a vault somewhere. The math is running and the institutions know it. Here is the pattern that repeats in every structural shift. The average investor waits for certainty. They hear the phrase petrodollar collapse and think, that sounds dramatic, but the dollar is still the world's reserve currency. The economy is still running. The stock market is still near highs. Nothing has changed yet. They are looking at the surface of the iceberg. Meanwhile, the institutional players have already moved. They did not wait for a headline. They followed the mechanism. In 2022, after Russia's dollar reserves were frozen, $300 billion seized overnight, central banks around the world began the largest gold accumulation campaign since records began. Over 1,000 tons per year for 3 straight years. Poland alone added 102 tons in 2025, its governor citing national security reasons. Kazakhstan posted its highest annual gold purchases on record. China added at least 225 tons officially, with analysts estimating true buying could be 300 to 400 tons higher through unreported channels. The retail investor saw the 2022 sanctions on Russia as geopolitical news. The institutional player saw it as the moment the dollar became a weapon that could be turned on anyone. The central banks started buying gold, not because they were predicting a collapse, but because they were insuring against one. By the time the average investor hears that the petrodollar is in trouble, on cable news, in a trending video, in a headline that finally makes it unavoidable, the institutional repositioning will be years old. The move will already be priced. The window will be closing. That is the retail trap, not a scam, not a conspiracy, just timing. The institutions move on mechanism, the public moves on narrative, and the narrative always arrives last. Before we get to the signals, tell us in the comments, when you hear the dollar is losing its reserve status, what is the first thing you think about protecting? Your savings, your purchasing power, or your retirement? No predictions here, no financial advice. What follows are 3 mechanical indicators, publicly trackable instruments that anyone can check. The mechanism described in this video either continues or reverses. These readings will tell you which. Signal 1, the IMF COFA report, dollar share of global reserves. The International Monetary Fund publishes the currency composition of official foreign exchange reserves every quarter. It measures what percentage of global central bank reserves are held in dollars. As of Q3 2025, that number stands at approximately 57%, a multi-decade low. If this reading continues to decline, particularly below 50%, it signals that the structural demand for dollars as a reserve asset is compressing. The pace of the decline tells you the speed of the transition. You can check it yourself. The direction tells you where the mechanism is pointing. Signal 2. CIPS daily transaction volume. China's cross-border interbank payment system tracks real-time non-dollar settlement volume. In March 2026, CIPS hit a single-day record of 1.22 trillion yuan across 42,000 transactions. Signal 3. U.S. interest payments as a percentage of federal revenue. The Congressional Budget Office tracks how much of every tax dollar goes to debt interest. At the end of 2025, that figure stood at 18.5%, a post-war high. The CBO projects it will reach 26% by 2036. If this ratio accelerates beyond projections, it signals that the debt spiral is compounding faster than the government can manage, the minimum payment trap in real time. The mechanism is clear. The 50-year Petrodollar agreement has expired. The security guarantees that anchored it are being replaced. The settlement infrastructure that depended on it is being rebuilt, in yuan, in gold, in digital rails that do not touch the dollar. The U.S. national debt has crossed $39 trillion. Interest payments now consume $88 billion per month. Every dollar of reserve share the dollar loses makes the next dollar of borrowing more expensive. Central banks are not speculating. They are executing. 863 tons of gold in 2025, alternative payment systems processing record volume, swap agreements multiplying across 3 continents. This is not an opinion. It is not a prediction. It is the reading on every instrument available. A dam does not collapse when the first crack appears. It collapses when enough cracks connect. The cracks are visible. The connections are forming. The water is finding its path. The petrodollar is not dying in a headline. It is melting, slowly, structurally, mathematically, and the math does not negotiate.